Let's see what are the 3 best dividend stocks for beginners. Now, why for beginners? Because if you are new to dividend investing, first you have to understand that there are at least 3 ways to approach it. You can concentrate on the dividend yield, you can concentrate on the dividend growth, and there is also a third way, which we are going to talk about at the end of this video, and it is a way that is not talked about a lot these days. And whichever road you choose, you have to make sure it is the right one for you, the one that you feel comfortable with, the one that can achieve your financial goals. So, like with anything in investing, there is no such thing as one size fits all. So if we concentrate on the dividend growth, then a very interesting option is a company like Hewlett-Packard. It has a dividend yield of 3.6%, and a dividend yield is basically a rate of return you can expect if the dividend would just stay the same. Payout ratio is 27.2%. So this is the percentage of earnings the company is paying through dividends. If it's small, then you could look for another company that is willing to pay a higher part of its earnings. But if it's too high, it can become a problem. The company may not have enough money left to grow or to pay back debt. And the annual dividend growth for Hewlett-Packard in the last 5 years is 13.5%. Now, dividend growth rate tells us how fast a dividend grew in the past. And hopefully, this can indicate how fast it will grow in the future. When we valued this company a few months ago, the average value was around $45 per share. And the current price is $29. So the price looks nice. Yield is also nice. So is the payout ratio. But if we add the dividend growth to this calculation, we see that this can be a very interesting dividend investment. Let's assume that the growth that we saw in the last 5 years will continue for another 5 years. And then we get, after 1 year, $1.19, then $1.35, $1.53, $1.76, and after 5 years, $2. And we paid for one share $29. So now our dividend yield is 6.9%. And on top of that, we already got back $7.83. So that is 27% after 5 years. And we still have the shares of this company. But to really understand how powerful dividend growth can be, let's look at another 5 years with the same growth rate. Year 6, 227, year 7, 257, then 292, 331, and year 10, $3.76. So the dividend yield is now 12.9%. And by that time, we got back through dividends $22.66. That is over 78% of our investment. That's quite impressive. Of course, we have to remember that the growth rate of a dividend can change, and that the past growth does not ensure that it is going to be the same in the future. But looking at the past performance can really illustrate why we should consider dividend growth stocks. Now, let's take a look at the company that may not have such a dividend growth rate, but has an incredible dividend yield at the present time. And that company is Altria. It has a dividend yield of 8.5%, payout ratio of 76%, so it is a big payout ratio, much over 50% that we are looking for, and the annual dividend growth rate of 7.2% for the last 5 years. And when we valued this company around half a year ago, the average value was $37, and the current price is around $44. So in this case, we have a company that is close to being fairly valued. It is a little bit on the expensive side, but not by much. The dividend yield is very high, and it also has a really nice dividend growth history. So it all seems great, but there is a problem with the payout ratio. So they are paying 76% of their earnings through dividends. That is a lot, and it may not be sustainable in the long term. So either their earnings will go up or the dividend will have to stop growing or maybe even go down. So let's just make some quick calculations for the next 5 years. If the dividend growth would decline by 1% every year, our dividend would look something like that. After year 1, $4.03, then $4.28, then $4.50, $4.69, and after 5 years, $4.84. So the dividend yield is by then around 11%. And we got back $22.34, which makes up 50.8% of our investment. And if we assume that from that time the dividend would just stay exactly the same with no growth, then this would happen. Year 6, 7, 8, 9, and 10, the dividend is at $4.84, and the dividend yield is, of course, at 11%. But by year 10, we got $46.54 back. That is over 105% of our investment, and let's not forget that we still have the shares. So this can seem like even a better approach than Hewlett-Packard, but we do have to remember that the fact that they have such a high payout ratio may indicate that this investment is riskier. The third kind of dividend investment is the one that not a lot of people talk about because it doesn't happen that often. It is a dividend stock that has a dividend yield that changes dramatically every quarter, and that may have a great dividend growth or a great dividend decline every quarter. It is basically a situation in which a company does not set a certain dollar amount for every share, but instead it wants to give a certain percentage of its earnings to the shareholders via dividends. So in this case, we don't look at the dividend yield or the dividend growth, but we look at the earnings. And a company I'm talking about specifically is ZIM Integrated Shipping Services. They intend to pay out in dividends every year something between 30 and 50% of their earnings. So if the earnings are great, you can have great returns. But if there are no earnings, you will not get any dividends. Its dividend yield is currently 97.5%, but in the case of this company, it is not a very useful metric. Payout ratio is 44.2%, so exactly where the company wants it, between 30 and 50%. Dividend growth, on the other hand, is 0% because we need to have data from the last 5 years to actually calculate it. We recently did a valuation of ZIM and the average value was $111 and the current price is $17. So it is very cheap. Of course, we have to remember that it is a cyclical business, so we should be cautious when seeing those valuations. But you do have a decent chance of making money not only on a dividend, but also on the company shares going up. This kind of dividend payments really resonates with me because it is very close to one of the main principles of value investing. If we buy stock, we don't buy a lottery ticket or just a piece of paper. We own a part of a company. And if you are rewarded if the company is doing well, and you are not rewarded if the company is not doing well, then it really means that you are a co-owner of that business. Your financial results are intertwined with financial results of the company. So you have to decide by yourself which kind of dividend company, and not specifically any one of those that I've mentioned, but which kind of a dividend company is right for you. Do you want to have a stable income and a peace of mind? Do you want to own a dividend company for only few years or maybe few decades? Are you okay with the fact that you don't know how much money you are going to get every quarter? Or do you want to know the set amount every time? Each of us has to answer these questions for ourselves and then make a decision that makes us feel comfortable.